Put credit spreads. We've got two sides of the same coin. There's the call credit spreads. That's going to be our bear call spread. Puts are opposite of calls. So with a put credit spread, we're talking about a bull put spread. From the name, what do we want to happen with the market? Do we want it to go up or down? We want it to go up, right? We're bullish. We're also neutral because we're selling. Anytime that we sell options, we're okay with no movement. So that's one of the things. Anytime we sell, it's typically you're neutral to blank, moderately bullish, moderately bearish, what have you. When we sell a put credit spread, again, we've got that defined risk and defined reward. We're selling options, so the most that we can generate in terms of profit is the premium that we collect. The risk that we have is the difference between those strikes. And again, we'll see that in an example how that works. But with spreads, we've got that defined risk. We've got that defined reward. We know how much we can make. We know how much we can lose. Again, we need to monitor these positions. We need to know what's happening. When we sell puts, what is the general outcome? What is the obligation of a put seller? They're obligated to buy the stock, right? Obligated to buy the stock if we receive an assignment notice. When we sell a put, we may want to buy that stock, right? There's a strategy called a cash secured put where the ideal outcome is we actually do get assigned and we buy that stock, but we're buying it at a discount. So with a cash secured put, typically you choose an out-of-the-money strike. Stock's trading $50, maybe we sell a $45 put with the hope that we get assigned and we buy stock at $45, when today it's trading for $50. So when we do a put credit spread, our first step is to choose that strike for the short put. Where do we want to buy those shares if we get assigned? The second step is, what if we're wrong? Stock's trading $50, we sell a $45 put, we would love to buy that stock for $45. What if stock goes to zero? What if it goes to, $2? If we sold that $45 put by itself, we are obligated to buy those shares for $45. They're trading in the market for $2. Is that a good trade for us? Not at all. We're not going to be in the business of trading very long if we continue to have trades with those kind of losses. To offset those losses, and not really offset, but maybe to prevent those losses, to protect against those losses, we're going to buy protection. We're going to buy insurance. Now, it's not technical insurance, completely separate product, but the concept is the same, right? If something goes wrong, we're protected. In this case, with the bull put spread, if something goes wrong and stock drops precipitously, we've got a long put in place paired with our short put to protect us from that risk. So stock's trading 50, we may have a short 45 strike put that obligates us to buy the stock at 45 if we get assigned, which might be what we want. But in case stock goes down below 45, we now have a long 40 strike put to protect us from $40 and below. With a bear call spread, we had the long strike works as protection should things go up. With a bull put spread, we've got that protection in place should things go down. So again, here's our scenario. Remember, stock's trading 87.5. Our favorite stock, XYZ, we've got 28 days until we expire. And we look at our option chain, stock's trading 87.5. We've got an $85 put that's trading for $2 and a nickel. And that's our forecast, right? We want to sell that put because we think stock prices are going to go up, and we either want to be assigned in buying that stock at a discount, or we want the contract, our short contract, to simply expire without value, and we keep that premium to ourselves. So that's our forecast, that short leg. It's the reason we're doing the trade. We also add that that 28-day 80 strike put just in case things go wrong. So that's our protection to the downside. Our spread is a net credit of $1.35. We've got the 80, 85 bull put spread on, neutral to bullish is our forecast. Our maximum gain is going to be what? We're selling options. How much can we make on this trade? $1.35, right? So our maximum gain is going to be limited to the premium that we collect. Just like with any selling strategy, whether we're selling spreads, condors, butterflies, or naked options, whatever we sell it for, that is going to be our maximum gain. Our maximum risk with a bull put spread is going to be the difference between the strikes minus the premium that we collected. And like I said, we'll get to an example where we show that in just a moment. And then because our risk is 365, that's what we would expect our broker to require for margin as well. Margin is going to vary for broker to broker. Obviously, contact your broker to see what their margining requirements are. And our break-even point, that is going to be our short put strike, where we are obligated to buy those shares. So if we have to buy stock for, what's our short put here? Our short put is $80. Our short put is 85. So if we're obligated to buy stock for $85, and we collected $1.70, $1.35 in premium up front, we're really buying that stock for $83.65. So if we get assigned, our cost basis for those shares are going to be $83.65. So that's going to be our break-even point. Anything below that, we're going to be profitable. Anything above that, we're going to go ahead and, anything below that, we're going to lose money. Anything above that, we're going to be profitable. Here's what it looks like graphically. Shares finish at or above our short strike of 85. Both contracts are going to be unexercised and unassigned. That would be our expectation. I'm short the $85 put, stock's trading 100. Is anybody going to want to put that stock to me at $85? My 85 strike put, that short put is going to expire unassigned. It's unlikely that anybody is going to put that stock to me at 85 when it's trading 100. The second part of my trade is my long 80 strike put. I'm not going to want to exercise that and sell stock at 80 when it's trading in the market at 100. So I'm going to let that contract expire worthless. So now I've got a long put I'm letting go expire without value. The short put is expected to be unassigned and also expire without value. That premium that I collect up front, that's going to be my maximum profit potential. I'm going to retain 100% of that. If stock finishes below, let's see, so that's at or above the strike price of 85. If we go below our break-even point and stock finishes below our strike of 80, for example, let's say stock finishes at 70, what's going to happen? Well, the 85 put that I'm short, I'm going to get shares put to me at $85. So I'm going to be buying stock at 85. I'm also long the 80 strike put, which gives me the right to sell those shares at 80. So stock gets put to me at 85, I turn around and sell that at 80. I lost $5 on the stock. That's offset by the $60 by net credit of $1.35 that I collected at trade inception. So I'm going to have a maximum loss, $5 on the stock minus the $1.35 that I collected up front. That's going to be my maximum loss of $3.65. It doesn't matter if stock goes to zero. I'm still going to be buying shares at 85, and I'm still going to be selling them out at 80. All right, does that make sense? So it doesn't matter where shares finish below that long put strike. That's my protection. That's the reason I have it, and in this case, it's working out for me. If shares finish between our strikes, between the 80 and 85, this gets a little trickier, right? Let's say we've got 80 and 85, stock finishes at 82.5, right in between. The short 85 strike put that I sold, somebody's going to force me to buy those shares for $85. They're trading 82.5 in the market, so I lost $2.50 on that stock. My long $80 strike put, I'm not going to exercise that. Sure, I can sell my stock that was just put to me. I can exercise that long put and sell those shares at 80. Yeah, I can do that. Or I can sell it just outright at 82.5 in the market where it's trading. So likely that long put is going to expire without value. Now I find myself with the long stock position, long from $85. And wherever I liquidate that, whether it be at 82.5 or below, or maybe I just hold the position and wait a little bit, either way, wherever I finally liquidate that stock position, whatever profit or loss on that stock is going to be, I'm going to take the premium that I collected when I sold the contract, and that's going to be my net profit or loss. And that is a bull put spread.